Good day and welcome to the Rand Swiss Weekly Wrap with Viv Govender. This is our usual wrap once a week about what we see in the market and some stories that I think might interest clients and help them invest their money better. The first story of the week is going to be our local inflation number, which came in at a 13-year high, 7.8%. It's a very high number for South Africa, not quite as out of bands as we've seen, for instance, in the US and the UK and some other places in the world. For instance, the US went over 9% at the worst. The UK, it's over 10% at the moment. But ours is rising. This number basically does indicate that the South African Reserve Bank is probably going to have to continue with its rate hiking cycle, even if it wasn't basically being forced to do so by the fact that the US is raising rates. Remember, if the US raises rates, we've got to pretty much follow at least as much and probably a little bit more over the long term, because of the fact that the US is in competition with us in terms of returns, and we are a much worse risk than the US is, and therefore we have to offer higher returns. If the US is raising rates, giving higher returns for money in dollars, we've got to increase rates that give higher returns for money in rands. So the inflation number, like I said, very high. Now, whether or not this is the peak or not, there's a couple of ways to look at this thing. Yes, we have seen the oil price come down substantially from the highs. We have seen the rand strengthen a bit, but both those trends have reversed in the last couple of days. So the oil price went from like 120 plus to $90 a barrel, massive drop down. The rand went from about 17 plus, mid-17s almost, to basically low 16, 16.20 or so on. At the moment, as I do this, the oil price is just about $100 a barrel. The rand's about 16.80 to 16.90. Now, in terms of what that means, one of the biggest drivers in this country for inflation is obviously fuel. Fuel price increases over the last year, according to the inflation number from basically that we got released this week, shows that over the last year or so, we saw inflation basically in fuel of over 50%. Okay, there's obviously a huge impact on the economy. It feeds into everything else, and it does cause overall inflation to rise. Transport costs are a big factor in any kind of good or service out there. So, if we are seeing some of that positivity around oil prices and the rand disappear, maybe some of the positivity around inflation peaking should also be reduced. What my real concern is looking at what's happening in Europe. There was a report from Citigroup this week that they expect inflation in the UK for January to be over 18%, 18% in January next year. That is an incredible number, 18%. It's more than double our current inflation number. Now, the thing is that I believe that what's happened in the world is there's a bit of a bifurcation when it comes to inflation. Some countries like the US have seen a peak and may even have seen a total peak, the 9.1% might have been a peak that might not be reached again in the near term or medium term. Other places, I think, are still on the rise. Now, what is the difference? One of the things is that where does the supply of energy come from? The US is a producer of energy, therefore it's able to supply its own energy from its own sources, and to a certain extent, because of the fact that it's separated by the rest of the world, or for most of the rest of the world, by two oceans, that energy finds it difficult to escape and to go other places, and therefore they have their own basically local energy price. So they don't get affected as much by the international prices as, say, for instance, countries in Europe do. So what that means is that the US inflation rate may not be as badly affected by things, for instance, like the rise in natural gas and the rise in oil prices. Not to say oil prices and gas prices are not rising in the US, they are, but they're not being affected by as much. The US also is a big producer of food, and therefore, to a certain extent, they're insulated from the international food market as well. And so also they are a big manufacturing center, and the dollar is the reserve currency of the world, a number of other factors. The US may not be the case to look for when it comes to what is the core indicator that we're going to be looking for to see whether or not our inflation number is peaking or not. It might be a smarter idea to look at what's happening in Europe. And in Europe, inflation looks to be getting much higher. And we're talking about, like I said, 18% for the UK, double-digit inflation, very likely for most of Europe. And if that's the case, and we are going to be following them, I don't think that we have hit the peak inflation number for South Africa at 7.8%. The US may have hit it at 9.1. We have not hit it yet. And that's obviously going to be, quite painful going forward. And remember my thesis that, high inflation is going to cause more civil unrest in South Africa and other parts of the world, because it's going to cause higher cost of living. It's going to make, consumers, workers, have a great deal more pain when it comes to how they operate. And I think we actually are seeing it even in the developed world right now. There was a strike in London for the transport services there, and that was driven by cost of living increases. So yeah, that is one of the bad stories out there. The next story to look at is Jackson Hole. Jackson Hole is this little conference that central bankers get together, and that over the last decade or so, ever since Ben Bernanke in the late 2008 basically, during the financial crisis, came out with some really big announcements from that particular conference, has become a huge event. And we often, as market watchers, look at what the central bankers of the world say, most particularly what the US Fed chairman says. So Jerome Powell is set to speak on Friday. What we're looking forward to is what he's going to say around, firstly, when does he expect inflation to, interest rate hikes to stop, and possibly when does he expect them to start reversing? Okay, these are important factors. Now, I think this is a bit aggressive in terms of expectations. I think the US Fed is cognizant. It knows that it's basically facing a huge amount of skepticism about its ability and its willingness to basically fight inflation. And one of the greatest powers the Reserve Bank has is its reputation. Okay, that's one of the things that the Reserve Bank has to guard most carefully, is its reputation. And right now, the market is basically saying that the reputation of the Reserve Bank is for cowardice. It's for the US Reserve Bank is for cowardice, that they will basically back down at the slightest indication of higher unemployment or a significant slowdown in economic growth. And those factors are going to be enough to push them to reverse these rate hike, or at least pause them for a bit. The reason that this is troublesome is that if the market no longer believes that the Reserve Bank is going to fight inflation, it takes away one of the biggest tools the Reserve Bank has, central bank has, and the central bank therefore has to act more aggressively in actual action as opposed to just verbal, announcements. What do I mean by this? Imagine somebody doesn't believe your threats anymore. You've got to back it up with force. If they do believe your threats, you don't have to use the force, because the threats are enough to basically cause action. So if the Reserve Bank, so if the central bank, the Federal Reserve, loses the belief in its threats, it has to act with more action. That means more actual interest rate. And that is obviously going to be a big deal. And the final thing I want to talk about today is the US basically has announced a massive student loan forgiveness program. It's about $10,000 for people that earn about $125,000 a year. Now, to give you an idea how big this is, recently Biden announced its inflation fighting package that was meant to basically have a huge amount of savings over the long term. The debt forgiveness that he just announced would take away all those savings, literally. It's hundreds of billions of dollars worth of extra, stimulus to the economy, because it means that these people that were, expected to pay back these $10,000 loans don't have to pay that, or $10,000 worth of loans don't have to pay that back. If I basically thought I had $10,000 worth of loans to pay back, and I had a certain amount of money on it, I wouldn't spend that money. I would basically save it for that loan repayment. If suddenly that loan repayment disappeared, that money suddenly becomes more free in my hands. I'd be more likely to spend it. And that's probably going to cause some stimulatory effects in the US. According to some analysts out there, we're talking about 0.3 to 0.4%. So it's not nothing. And the important part about this extra inflation caused by the stimulus is the fact that the Reserve Bank, the central bank of the US, would probably have to raise rates by 0.5% to overcome this extra little bit of inflation, all things being equal. So again, it's a stimulatory effect caused by political action in the US. Look, it may not go through this, but very flimsy legal arguments about why basically this should be allowed, basically based on post 9/11 laws put in place about forgiving debt in the case of war or emergency, and basically they are saying that the emergency is the COVID pandemic, and therefore they're forgiving debt because of the COVID pandemic, which at the moment I think is pretty much, in most estimates except for China, over. So yeah, that is the stimulus that we're seeing from the US that's probably going to maybe cause a little bit more inflation in the US that would otherwise have occurred. Like I said, not a huge amount, 0.3, 0.4, but understand that that probably would require a 0.5% hike in interest rates to neutralize. Okay, so that's it for the week. I look forward to speaking to you guys again next week, and have a good weekend. Cheers.